all excited to know more about stock market. For today's video we were going to tackle about a book review about stock market. This book review is all about a beginner's guide to the stock market. These are the key takeaways from this book. The stock market is a complex area that only seems confusing. The book lays out what a stock is and what to do in the stock market. It also mentions mistakes that beginners do that should be avoided at all costs. A stock may be a share during a company, thus you own a section of a corporation. A company has several shares, and one share are often priced otherwise for every company. What stocks to buy? The big mistake people make is buying a stock with a terrible price to earnings multiple. Don't buy any less than 10 as the company will very likely go bankrupt. Buy one around 15 to 20 PE instead. This also means not buying stocks that are penny stocks. Dividend stocks. These are the stocks that pay you quarterly. It's a pleasant method of gaining cash from firms consistently. From those dividends, you'll be able to purchase additional dividend stocks. As a result, you increase your money flow. Crater gives a basic introduction to stock market investing for people with little or no experience doing so. Crater advises investors to consider exchange-traded funds, dividend-paying stocks like the Dividend Aristocrats, growth stocks, initial public offerings, and covered call options. As with all investments, additional research needs to be done before adopting any of the strategies he briefly summarizes. Crater's reference to the ProShares S&P 500 Dividend Aristocrats ETF, Noble, was a helpful tidbit for any investors guarding an existing nest egg interested in dividends. Similarly, his advice to consider stocks hitting new 52-week highs and avoid those hitting 52-week lows is worth considering, especially since it runs counter to the value investing approach taught at my business school as I enrolled there. The time required to complete this book is very reasonable. It takes up to 1 hour to read. The stock market is the most extraordinary opportunity machine ever created. There's an easy way to own a piece of every dividend aristocrat. Buy some shares of Noble. It is the ProShares S&P 500 Dividend Aristocrats ETF. Until you become an advanced investor, don't ever buy a stock with a P/E of 10 or less. It's just a lousy hole to fish in. It is full of companies with giant debt loads, falling revenues, or outdated products like faxes and typewriters. And probably a few frauds as well. So stay away. Paying a low price for a stock going to zero is never a good deal. We call these situations value traps. They look like good values, but they turn out to be trapped. Here's the first rule for trading growth stocks. Ignore the high P/E. Great companies that are rapidly growing will always trade at high P/S. The float is simply the number of shares of a stock that are available for trading. To calculate the float, you take the total number of outstanding shares and subtract all closely held percentages, those held by founders, employees, and original investors locked up and thus unable to be traded. Don't buy stocks that are hitting 52-week lows. Don't trade penny stocks. Don't short stocks. Don't trade on margin. Don't trade other people's ideas. Focus on a few stocks, and get to know how they sell. Don't spread yourself too thin by trying to follow too many stocks. Beginners are better off investing in an index fund or ETF, especially during a bear market. Dividend aristocrats, companies that have been paying dividends for 25 years, for the long term. One of the critical decisions in evaluating a business is pricing power, when a company can increase the price without being afraid of being undercut by competitors. That's all. Thank you for watching. I hope you learned many new things about the stock market. Kindly subscribe to our channel and click the notification bell. Also, follow our Facebook page to learn more about the stock market.